We expect GDP growth to improve to 6% in the Philippines in 2024 versus 5.6% in 2023. Much of the improvement will come from a bottoming of the global electronic export down cycle, which we expect in the second half of this year, a reversal of government underspending that we saw in 2023, as well as a stabilisation of household expenditures, given that inflationary pressures will start to ease through the course of this year. Inflation in the Philippines has been a bugbear for 2 years now, and it peaked in early 2023. Since then, inflation has come down, but the disinflation process has not been smooth. It has been bumpy and volatile, largely because global food prices have been volatile. For the Philippines, rice prices matter a great deal and account for about 9% of the CPI basket. Given that global rice prices do remain elevated, we do expect that inflation will be sticky downward in the Philippines for the rest of this year. That said, it will definitely ease. At the same time, we've also seen core inflation pressures come off quite significantly since early 2023, which also suggests that there is a moderation in inflation expectations, which will continue to help the inflation profile lower through the course of 2024. In terms of the fiscal profile, we still expect that the government will continue with fiscal consolidation. The fiscal deficits over the pandemic period were extremely large, and fiscal consolidation is required to rein in those deficits. We expect the fiscal deficits to narrow in the medium term, consistent with the government's profile. This will require that revenues increase in line with nominal GDP growth, but also expenditures remain focused on capex rather than current expenditures. This for the Philippines is a much easier task to do because there are no retail fuel or electricity subsidies, and the pass-through from global oil prices onto retail fuel and electricity prices is quite direct. At the same time, we expect that the external balances will also improve as global commodity prices ease, and as a net importer of commodities, this will favor the Philippines' trade deficit, which we expect will narrow through the course of 2024, along with the current account deficit. As such, with easing inflation and a moderation in the external deficits, we see BSP having some room to lower its policy rate, consistent with our house view for the US Federal Reserve to cut its policy rate. Our forecast is for the BSP to cut its policy rate by a cumulative 100 basis points starting in late second quarter 2024. The risk, however, is that BSP delays the rate cuts into the second half of the year until it is convinced that inflation is actually on a steady downward trajectory. For the medium term, we expect that prospects for the Philippines will remain attractive. The government has implemented a number of structural reforms over the course of the last 2 years. These include FDI liberalization in key sectors such as public transportation as well as green economy sectors, which will make the Philippines an attractive destination for FDI in an increasingly competitive ASEAN space. At the same time, there is an impetus for the Philippines export sector to move up the value chain, especially for electronics, and to capture some of the increasing demand for semiconductors. As such, we remain positive for medium-term prospects for the Philippines economy and expect that growth will stabilize around the 6% handle. Inflation will return convincingly to Bangko Sentral and Philippines' target of 2 to 4%, and the external deficits will remain manageable.